Hi everyone, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I'm Arjun Parthasarathy, and in the first day of trading for 2022, the markets were steady. The government bond yields at higher levels of 6.46%. The Sensex and Nifty rallying again after falling in December, and the rupee also rallying after falling in December. On the economic front, the current account deficit came in negative at um, for the second quarter, why against a false surplus in the first quarter, largely through higher trade deficit, while the India's fiscal deficit was at 46.2% of budget for in the April-November period against 36% of budget in October, largely due to higher spending by the government in November. And on the tax collections front, India's GST saw high tax collection of rupees 1.29 trillion or rupees 1,29,000 crores in December 2021, indicating a robust tax collection. But having said, however, the highlights of the day is that RBI has started to intervene again in government bond markets. In the last auction held last week, the last auction of 2021, the RBI did not accept bids for the 10-year bond and the floating rate bond, as it did not want to signal higher yields. And again, in the previous to last auction, it gave the underwriters the bonds, again sensing that yields can rise, and it did not want to. And also, if you take the intervention in the foreign exchange market in December, the RBI, when the rupee was looking to fall, RBI came and sold US dollars. But over the full year period, in 2021, RBI has been buying US dollars to prevent the rupee from appreciating sharply. And the question mark is, are both these interventions good, whether it's in the FX market or whether it's in the government bond market? Because if you see government bond yields, they have risen sharply in the last 1 year. And RBI in 2021 and 2020 has largely been very protective of government bond yields. Initially, they were protecting the yields at 6%, then again at around 6% levels, and then let it go. Then again, they started protecting at slightly higher levels, but again, then they let it go. And as they kept protecting the market, Gsec investors continued to buy, thinking RBI is protecting the yields, but the yields are going up and they're suffering losses. Similarly, with the rupee, RBI, when there is a lot of flows and there is positivity towards the rupee, RBI is preventing the rupee from appreciating, and they've been buying the US dollars. And while helps increase foreign exchange reserves and protects the currency, protects volatility in the currency, but when it comes to the crunch, the currency still depreciates. And the question mark is, should the INR be allowed to appreciate sharply when there is positive sentiments in the market, and because when there are negative sentiment, it still depreciates sharply. So is protection really helping the market? These are question marks to be answered, but there is no right or wrong answer to this. And investors face the brunt of RBI intervention. Thank you very much for listening in. Do not forget to log into our Quick Invest platform for our curated list of bonds, where you get the bonds with the most information, highest transparency, and the best investment experience. The link in the description below will take you to the Quick Invest platform. And if you have not subscribed to your YouTube channel, please do so. Thank you very much.